Hello, welcome. This is smarthelping.com. I'm Jay. We've got a really awesome financial model for scaling studio franchises. It could probably be used for all kinds of different franchises. I do have a new mic, so hopefully it sounds better. And I've zeroed out all the assumptions in the model so that we go through everything and see how it all works. I did a couple things different here as far as how equities invested and distributed, and there's three different CAPEX schedules. Normally, I just have one. So there's a lot of cool stuff to check out. I'm going to go through each tab, explain an example scenario of how this works. And the main premise is you're going to define a bunch of attributes about a single studio, and then we're going to scale those over time. There's also some pretty advanced debt logic for master lines of credit, up to two, each with their own refinance at some point in the future, and then two working capital loans, and an option to use dynamic uh, loans for that are not credit facilities that roll through multiple studios, but a single loan that starts when the a new studio is opened, with an option for an interest only, and then switch to amortization. So there's a lot of things going on with that you can do with this with capex, debt, leverage. It's got a full three statement model with financial statements. Over here you can see income statement, balance sheet, cash flow statement. And I did quite a bit of testing to make sure everything works no matter what assumptions you put in, as long as the assumptions are logical. And remember, when you use these financial models, you're going to be putting your own numbers in based on your own strategy and research. And this is a big, giant, awesome calculator to put things into clean financial summaries, produce investor summary, pro formas, and returns and all that kind of stuff. Okay, so let's start. Let's call this business. We're going to call this fitness 1, 2, 3. We can go up to 180 months with the forecast. Let's say we do want to do a 10 year, so we'll do 120 months. We will include a terminal value, and we will base that on the aggregate 12-month trailing EBITDA from month 120 back, 3x. And this first month, the forecast is pretty much irrelevant, but it is there so you can see a timeline on like the monthly detail here. You can see what months is month one and so on, but it doesn't drive anything else. We've got some tax logic here. If you want to include that, it'll apply to your net income and capital gains, depending on how you want to show the exit. And then we have our sanity checks down here to make sure all the different statements and tabs are all in balance, and even checking to make sure the balance sheets are in balance. These should always be 0. If they're not, I would start by checking the timing of your assumptions and making sure, um, well, nothing's based on dates, so these should almost always all be 0. I can't even think of a scenario when they wouldn't be with this current logic, so you should be good to go on that. Okay, so the executive summary, investor summary, monthly detail, annual detail, I pulled those up front because those are viewed a lot in all these visuals. But the actual assumptions, once you figure out these first things we put in, is the studio expansion. So here is the meat and potatoes of your franchise or a fitness studio franchise forecasting. I'm going to model a single studio, but you'll be able to see how to think about it and then how to scale more over time. So here we just have a tranche ID. This means you can have up to 36 tranches of build outs. So maybe an ID1, we're going to call it, starts in month 1, and we launch a single studio. And then maybe we want to wait till month 13 after we've been working at it for a year, and maybe we want to launch another studio or 2 or however many. The nice thing about this model is you could scale an arbitrarily large or small number of new studios launched at each of these points in time. Each of these would represent a month number. Note that these month numbers don't have to go in order. You know, you could have, depending on how your strategies and how you want to group these, you might have month one here, maybe month 1 through 5, and then have another set of assumptions for a different set of type of or quantity of studios launching in month 1 through 5. Maybe some with using a credit facility or not, or some using a term loan or not. But all you can configure, because every studio is going to have the same scaling metrics once they start, is you can configure if they're going to have debt or not, what type of debt, and the count, as well as when, the timing of when the lease is signed. And so this date here would be when the lease is signed, and then let me zero this back out. And then here you can say how many months it takes from the lease signing to the open. So if I signed in month 1, okay, I'm actually going to open in month 5. If this were, say, month 3, and I opened, and it's still 5 months, then month 7 is the open month. So 3, 4, 5, 6, and then the 5th month is when I open month 7. Okay, so let's keep that for now. Let's say we're going to use the rolling credit facility. Now what this means is if you hit yes on this, it's going to use the loan terms here and the master credit facility terms. And if you have a refinance date here or month number in 37, it means every single one of these CAPEX and non-CAPEX startup costs that happen once a studio lease is signed are subject to, well, you could define here how much percentages of the CAPEX and non-CAPEX costs get financed. And then they will go through up to month 37. All those costs that exist will go through this interest-only rate at 11%. After month 37, and this can be applied. The idea is you go to the bank and say, okay, I want to open 6 studios over the course of however many months or years, and as you're opening them, you're going to draw on that credit facility, and then eventually you're going to roll them all up into a term loan at some point, and that's what this refinance event is for. Now, when the refinance happens, now you have a term loan with amortization, potentially a term that's different than amortization period, origination fees, and interest rate. So that's pretty dynamic. And then once you, so that goes. So after month 37, let's say in 38, you have more. You're going to continue to build out more, but you wanted to refinance at this point and then potentially start more in the future. Everything after this month will then go to the second interest-only rate, and that will start accruing, and you'll draw on that loan, and then that has a final refinance month. Let's say it's month 100, and that's a new term loan. And then at the end of the forecast period, if you do include the exit value, then any balance on these 2 term loans, which are shown in L1 and L2 here, and all the numbers will populate in here once I start filling out the assumptions. But these are the 2 master line of credits, and they will be paid back at the exit forecast period if you do include the terminal value. If not, it'll just show you what the balance is at the end of the forecast. If the term is within the forecast period, well, it'll just be paid off, just with the principal payments in the amortization schedule automatically. Okay, so that's probably one of the most difficult parts of this model I had to think through, but it works flawlessly and very great. Okay, let's go to the costs. So CAPEX reserves, let's say is 0.1. All this means is whatever your costs you have here, there's some kind of reserve you want to keep, so you might have to update them or re-buy equipment every so often. So this is its own line item of CAPEX costs that happen as a percentage of the total value of everything that you purchased. So let's say we want to finance 80% of all the CAPEX with the credit facility, and let's say when we sign the lease, so these are relative to when the lease was signed. So here we're signing month 3. We're going to say for renovation construction, we can go over to our CAPEX detail and define all those costs. Let's just say, I'm just going to do it all in one big thing. Maybe you are going to do $150,000 in renovations. Maybe you'll do 50,000 of something else, and then maybe 10,000 of something else. And every single time you open a studio, these costs happen. Now, what this model does very good is spread those costs out according to when you think you're going to have to pay the costs relative to when that lease was signed. So month 3, you sign the lease, you know what these costs are for each of these types. And then we say, okay, well maybe 25% is paid up front, and then maybe in month 4, the other 75% is paid. So that pattern, so 25% of 150,000 is paid in month 1, 75% of 150,000 is paid in month 4. That will apply to every single studio you have here, and it will, if you had 2 or 3 or 4, it automatically knows to multiply the cost by however many studios you're running or opening. All right, let's say equipment. Maybe you're going to buy all the equipment up front, and then other capex. Let's say maybe 50 up front and other 50 in month 3. Okay. Then we have non-capex. So this could be something like a franchise fee. If we go to capex detail, these are not depreciable items. So let's say, franchise fee of 25,000 every time we open one, and then maybe there's some other costs. I had franchise fee here, but we could change this to maybe a marketing campaign just as you open, maybe $10,000. Now if we go back over to Studio, we'll say, in this case, this is, and let me see if I labeled these. So this is the source of what these are. So in this case, this is franchise fees, and this is marketing. In this marketing, you might have ongoing marketing, but this is like an initial push, is what I'm modeling in this case and scenario that I'm going over. So maybe I would say if I open in month 5 relative to when the lease was signed, maybe I do some marketing in the first 4 months. So that 100 or that 10,000 gets spent over these 4 months on every time I open a studio in month 4, 5, 6, and 7 of the tenure of that studio from the moment the lease was signed. Franchise fee 100% up front. And remember, I could also say how much of these costs am I going to finance. Maybe with the credit facility, maybe I'll only finance half of these. Okay, and then interest only rate, 11% is fine. We'll refinance in month 37, and these terms are fine here. We'll talk about the term loan after, but the term loan is just if you have term loans selected instead. The only difference is it does a separate loan for every single tranche of studios rather than rolling all of these finance costs into a big line of credit and transferring it into a refinanced term loan at the end. This just has, it's like a new loan for every single new tranche of studios, and it has its own terms. There is an interest-only period, which is pretty tough to model, but it works. So a little bit different type of profile of debt, but you can use either of these or both if you want, and you could configure the percentages here so it's super flexible. Okay, so now that we've defined that, let's go to our revenue. So here we can say, well, how many members is the average studio potentially going to have? Let's say, the maximum possible capacity we think they could ever have is 1,000 members. And then we say, during the tenure of the studio, how much of that capacity do we reach in month 1 of the studio opening? And remember month 1 here is month 7 in this case, because it's always the open month. So let's say we start at maybe 10% capacity, Then maybe we jump up to 20. And remember, every single studio that gets opened over time will follow the same pattern. Maybe 35, maybe 65, and then finally in month 4, maybe we get to 80% and we stabilize at 80%. Now you could configure this however you want. And then we say 3-member pricing. Let's say there's 3 options that you can sign up for, maybe a $20 a month, a $75 a month, and a $150 a month. And those things might have or entail different options. And I do have a way so you can define the cost per member type in the OPEX down here. So if different types of members have different cost profiles for direct costs, you could configure that here and match it up. Okay, then let's also say some percentage of the members, maybe 25% purchase other things, merchandise or what have you. Let's say the average amount of purchase is $80. And let's say you were going to average 20% margin on whatever those items are. Okay. Annual price increase, let's just say prices will go up on average 1.5% per year. So I did a little table that's nice that shows you what in today's prices, this 20, 75, and 150, what that would be if it grew at 1.5% per year in year 15. So here you started at 20, you end up at $24, 75 goes to 92, and that's just to account for inflation or however you plan on doing your price strategy. And then let's say 25% of members are tier 1, 50 are tier 2, and 25 are tier 3. And let's just have that go all the way down for the whole thing. So here's our total members we expect to have on a given studio over time and how much revenue we're making per month. And that all will be dynamic based on what you put in these figures here. Okay, so we have our average single studio modeled in the revenue. These M1 and M2 tabs are just how all this dynamic logic is working. It's quite complex, but it is clear and easy to follow if you're good at just following formulas and logic. OPEX. So this is for corporate overhead. So for example, maybe we have some scale out of some different things, such as legal. Whoops, not over here. Legal fees, office rent, different things like that. Well, this is sales and marketing. I'm just going to put this back to how it was, but maybe sales and marketing, we're going to spend some money on maybe a sales director, and we can increase the cost of that over time. Well, actually, no, we have a different tab for staffing. Maybe this is just some sales and marketing costs that we're going to have that goes overarching over all the franchises, maybe at $10,000 a year. And this is annual amounts. Maybe another cost for $5,000 a year, and so on. You can configure this however you need to. Now G&A, maybe you've got some executives or general managers. Rent, things like that. Maybe that'll start in month 13 if you're getting going. Oh, so I keep forgetting I have a different tab for staffing. That's not now. There's going to be a difference in the cost on a studio level and a corporate cost. So these are corporate. So legal fees, maybe accounting, just different things like that. So we'll start those all in month 1. Office rent, maybe 50,000 a year, maybe 80,000 a year, and maybe accounting costs maybe 15,000, depends. And also you have R&D, same setup. And on all these sections, I did where you can define a percentage growth increase annually, and then here you can just manually define the costs, so it's a little bit more flexible. Um, and then we have cost as a percentage of total revenue. So let's say maybe of all our revenue collected, we pay 3% in credit card fees, we pay a franchise fee, maybe 7% of gross revenue, and then maybe 1% in ad fees. Now, if these fees are not relevant to your scenario, you can always zero them out. Then we have per studio cost. So here is where we get down to the studio level. So we say these costs, and there is 10 of them, are based on whenever the studio lease is signed. So obviously the lease is signed, you're going to be paying a lease. And these are annualized amounts. So let's say maybe it's 120,000 a year for the lease. Maybe utilities are, they can't be that much. Say, I guess it depends on what the franchise is. Maybe 15,000. Property taxes, it depends. Maybe 36,000. And so these costs will start as soon as your lease is signed, based on this date here for each of these in the count you have. And then down here we have costs starting when the studio opens. So remember, studio open is some point in the future, usually from when the lease starts. It doesn't have to be. For example, if you put this at 1, then that means everything starts as soon as the lease is signed. Put that back to 5. So here we say, okay, once we open a studio, we have staffing costs. Let's say you have to have a certain amount of staff. Maybe per year it's 150,000. Maintenance to just clean, repair things, upkeep, what have you, maybe 60,000 a year per studio. And then if you're going to spend your own marketing budget on each studio, let's say modest amount, maybe $24,000 a year, $2,000 a month. Okay, so every studio is going to have these costs. Now I also have a couple other ways you can do costs for a studio. Here is based on the member counts and based on the total member counts of each type, you can have a monthly cost, and this is monthly now. So let's say every month maybe you have type 1 costs you, $10, maybe type 2 costs you 15, and type 3 costs you maybe 30. So this is just going to multiply by the amount of active members times this cost, and that's the cost per month. And then you can increase it over time if you would like. And then finally, we have a dynamic cost schedule to scale with your studios. So what this is for is to say if you open a studio and you think the studio might expand in the future, maybe you're going to add staff or add different things as the timeline of the studio goes up from opening month and forward, and as you grow, maybe you have some dynamic costs that don't exist at the very beginning, but then maybe they do exist over time, or maybe they're smaller. So maybe it's $100 a month to start, and then eventually it goes up to 300, and then maybe 1,000, and then let's see, what month are we stabilizing in? Month 36, 7. So let's say this is 400, and this could be just a whole range of costs. It just applies to the count of studios times this amount, and it's going to be dynamic again for each studio launch. Whenever it launches, it'll follow this timeline of these dynamic costs. Now this $100, even in month 72, so it goes for up to, you can enter it for up to 72 months, and then whatever you have in this last box will go to for anything after month 72 of the tenure of a studio. You can also increase this. So let's say if it's $100 in month 1, that might be a little bit more in the future. Maybe you want to increase these costs at 1%, and all that's going to do is look at the year of the model and do a compounded growth of whatever these costs are and apply it. So you would want to put costs in here that you think that would be existing today, not what you think the price would be in the future. You would want to do today's costs for this section. Okay, so that's OPEX. C1, 2, and 3 here. You can see it's just the cost basis for each tranche for the three different types of CAPEX we have. Remember, there is three different CAPEX items here, and there's a C1, 2, and 3 tab for each of those. And all you're doing on this tab is defining the useful life, which will define the depreciation of each of the different CAPEX items. Other staffing. So here would be like corporate staff. Maybe in month 13 you want to get a general manager or something for $75,000 a year. You know, general manager. And you could assign all of these different um, staffing items. You could do different counts. This is just another way to have flexible corporate costs that might be you need to scale by count over time. And there are also payroll tax and benefits that will be counted onto that cost. Um, L1, 2, and 3, I already showed you where the line of credits. Now you can see there is some data here coming in once I populated it. So we've got some draws on those loans based on 80% loan to cost. You see interest is popping in here. And then when we start repaying it in month 37 or we refi the line of credit into a term loan, we can see now we've got a principal and interest payment. And here I've separated out. So I've got principal and interest here, which has automatic repayment. Here in this case it'd be, I believe, on the end month of the model. Yeah, month 120, because it's still going. The term loan's got a 10-year term. And, well, it's actually kind of close to the end of the... No, it's not. It's on month 84 here, so it's still got a ways to go, but we're repaying it because we're closing out. We're closing our terminal value, so we want to show that debt being repaid. But over here, I have a column that's principal only, and then here is the principal including the repayment. So the reason why I did that is you might want to call out the debt service coverage ratio, and for that you just want the interest and principal each period and not looking at this bulk repayment. And the same idea goes for the term loan. And I did separate that out as well. So you won't see that in all the different term loans. You'll see a nice amortization only calculation on those. I believe the term loan is way down here. Yeah, I've separated out the payoff for the term loan. And then you've got principal up here. And on the monthly detail, you'll see where these debt areas. I broke it out down here. Total basis for debt service coverage. And then the principal is all these in here. I have got the calculations to call out just the principal amounts. Alrighty. So that's that. Other staffing, this, other startup costs. These are just other, initial costs that happen right when the business starts in period 0. You might have some other costs that need to go in there. And terminal value. Here in this case, well, I've modeled a scenario where the business loses money, so this is negative. I'm going to adjust that here shortly. But this is just to define on the exit if any percentage of the sales proceeds, which is extraordinary income, goes to any CAPEX items, and if so, you can define how much goes to the three different main CAPEX categories, and that will just affect your taxes a little bit, after tax proceeds. I just keep it at 100% usually and don't worry that much about it, but you can configure this however you want and it all does work, and I've checked it all. So those are all the assumptions. Now let's look at what we actually did. So if we go to the monthly detail, in month 3 we opened a studio. It had some costs, so if we go down here, we had CAPEX 37 in renovation construction, 50,000 in equipment, 5,000 other CAPEX. We also had franchise fee here. So we had some costs, about 117,000, but we did finance some of this. So we had 86,000 in financing here. And note we did have some more financing coming along with some of those other bigger CAPEX items. So this is kind of your initial cash flow plan. And here's the cash flow after taxes. So we can see how much we actually need while everything is going on, and including all these different operating expenses. Here's your revenue. Revenue is not starting until month 7, and that's completely dynamic. So if I had this at, say I put this at 6 months, now revenue wouldn't start till month 8. So you see everything is shifted over. So you get member counts, revenues, other revenue, which is that other ancillary based on what you're putting in here. Total revenue, refunds, cancellations, discounts. You can put a percentage in right here, and that will just be multiplied by the total revenue. And then we have our gross revenue, which is what we base things on, like ad fees and ongoing franchise fees. So here, dynamic based costs, this is where when you define that on the OPEX, these costs, so $100 a month to start, and then it goes up over time. So you can see here it's 100 and then 300, and then it's a little bit higher because we've got that 1 point some percent, whatever it is, growth rate. So, and since we only have one studio, you can follow this pretty easily over and make sense of the numbers. You can see we started at 100 members because we're at 10% of 1,000, so 100 members at $8,000 in revenue a month. So you can see that here, 8,000 different numbers or different tier types, and then that's going to go up over time. Remember, we have a income or a pricing increase here of 1.5%, which is going to be taking effect on these figures. So if we have one studio, eventually, by year 9, we're doing $72,000 a month in member revenue, 18,000 in other sales, 6,000 in discounts and so on, so $83,000 in gross revenue. We have other costs here, 1,000, lease, $12,000 a month, utilities, and this is taking those numbers we did divided by 12. In total, we have 72,966 direct costs related to the studio. So pretty tight margin there, 13%. And we still have our other corporate overheads, so we are losing money here. Credit card fees, franchise fees, ad fees. We scroll down here, so negative EBITDA. We've also still got some debt service. Here at this point, we've gotten to our amortization point in the loan, so we're just paying principal and interest. And we've got ongoing asset replacement still happening, so we are just burning a little bit, not huge, but we do lose money every single month, and then we exit at a negative, so that's obviously not what you would want to plan out. Let's adjust the assumptions a little bit. Let's say, so my costs are quite large and probably too much as far as the ongoing. Also, let's say this is a little bit more aggressive, maybe 20%, 40, and then 75, 80, and then maybe within 4 years we get to 95% of the maximum capacity. Let's also raise these prices a bit, maybe $50 for this, 100, 175 a month. Now keep in mind, let's increase these margins. This is all, everything I'm inputting here does not mean anything. I'm just putting in some random numbers. But I'm just doing it so you can see how to change it when you go and plan your strategy and try to figure out, okay, what on average does my studio look like over time? You can know what to change to do that. these OPEX items, let's just say we're only going to do the studio related costs. Now there are going to be some legal fees, but let's, you know, lower that down a bit. Office rent, let's say we just super cheap, 6,000 for this. I still think we need these costs. Now this, so the studio cost, I think this might be a bit much. Let's say, 48,000 a year for our lease on that. Utilities, 10,000. Property taxes, let's say 15,000. Staffing, maybe it's a pretty lean studio. Maybe there's just one main staff person, so let's cut that down. Maybe 90,000. Maintenance, maybe 25,000 a year, and marketing advertising, maybe 10,000. Also, these direct costs per member per month are a bit high. Let's say this is like, and this would be things for like point of sale systems and costs that are completely dependent on the amount of members you have, and you don't want to double count if you've already got those costs accounted for elsewhere in here. Let's say maybe this is like 50 cents, dollar, maybe $3. These costs I'm fine with. Okay, now let's look at our executive summary and see if we're making money. Okay, here we go. So now our EBITDA is positive. We have a nice exit, 2.2 million, year 10. 86% internal rate of return using the monthly convention. Pretty good. Now minimum equity, let's see. I think it's time to jump into the cash flow planning as far as how much money you're going to raise. But why? So this is C13. Total equity raised. Right, so we have nothing in there. We need to raise at least 250,000 based on all these different assumptions. And then this is a negative because I haven't done any of the investor inputs yet. But we know, based on this one studio, this is just one studio, not anything else, just a single one, launched in month 3. So here's what it's doing, up to 1.5 million in revenue in year 10. And you can this is a good thing to sanity check a single studio with, is you can use this model for that. And you could also have a separate version of the model that maybe has a scaling out of multiple studios and maybe some different terms for the loans and exit values. But basically, if you look at this, our initial costs, actually it's better to look at the monthly detail to see how far we get down. So our minimum there is 250, I believe, in month 16. Then we start turning a profit. So that must be when we actually get enough members to go positive. So month 17, which if we go over to the studio, actually the revenue tab, month 17 is still at 40. I'm just trying to see what happened there. We're still in year 2. We've got some costs going up, but revenue has gone way up here. What happened? What was our increase in revenue from? Members. I forgot. Month 1, month 17 is actually 3-month offset because we didn't launch till month 3 for the studio. So in reality, this increase in month 17 is actually, with the model, it would be month, what is that, 14? Or am I mixed up here? So we started in month 3, so we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Oh wait, sorry. We opened in month 8. So this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 1, 2, 3, 4, 5, 6, 7, 8, 9. So this is month 10. Month 10. And it's really good to go through this. You guys can get this, really see how this works. So there you can see month 10 does have the increase from 20 to 40%. So in the life of this studio, month 10 is model month number 17. And that's because we started month 3. We had 6. We don't open until 6 months after that. So 3, 4, 5, 6, 7, and then the 6th month would be 8. So we open in month 8. So that's why we got the increased capacity. We're now positive on our EBITDA and chugging away, trying to grow here. Now there's still, so what's this? Oh, taxes are taking into effect now because we're profitable in year 3. And remember, there's a lot of things going into profit. You got the interest, depreciation, which all impacts that. Now, what we are doing here is, so we're planning all our cash flows. We see cash in and out. Now we want to know, well, we have to put some money into the business. Either we do as owners, operators, we have to raise some money. So I've made it really simple. Here in row 280, you put how much you want to invest, or I mean, you either invest or raise money, and you could see the minimum you need is 250,000 because that's the minimum we get to, or roughly slightly more, let's say 255,000. There we go. And now our cash balance down here is never goes below 0. And you can see the reserve would be the difference in the amount you need at minimum versus how much you raised. So we have just barely a surplus of $4,600. And you could define how much you want to distribute as you're making profits to investors. And then these two things, you define these up top, and then we've got 3 potential investment rounds, or it could be owner investment rounds too. And so this defines the percentage of the total investment that round 1 does, round 2, round 3. Now I've just done, let's say this is 80% and then 20, let's say 10 and 10. Now I've made this so it just equals the first month's percentages all the way across, so you don't have to keep changing it. But it's very likely that you will change these, and that's fine. Don't worry that these are formulas. You can override the percentages to whatever makes sense for your situation. So we have, of the 255, 204,000 invested by round 1, 25,500 by round 2 and 3. So based on that, the operation is negative 50,000 cash flow rate to start. We're racing some money here, so now we've got 205. And then as we start to use this investment amount to fund the operations and stuff, it goes down. So you can see our cash balance is going down here, down to 150, and eventually down to 4676, which is quite low. So maybe we want to raise 500,000 to have a little contingency. Now we've got a little buffer, $250,000 reserve. So this makes sense. Now, as you start to make money, you can do distributions here, and it'll just flow based on however much, and there's a separate percentage to define how much of the distributions go to each party, because it might not be exactly pari passu depending on how the terms of the deals are. So you distribute cash. Now this model automatically, if you haven't distributed any money at the exit, the model automatically takes whatever the cash balance is and sends it to the investors accordingly. Now here I have 0% entered, so let's just say this is pari passu. So the money you get out is the same exact percentage you put in, so 80, 10, and 10. Now if we go over to our exit month in month 120, you can see here it's distributing the extra amount. Now, if I were to say distribute some money here, say $1 million. Okay, now you can see the final distribution goes down. Wait, sorry. I put in the target investment. 1, 2, 3, 1, 2, 3. So there you can see it goes down from 5.6 to 4.6. So we distributed $1 million here. So that works dynamically to show, just kind of clears everything out on the exit month if there's any cash left in the business. It's just a nice thing, so you don't have to manually do it. I think it's a super nice feature because originally I just had these two rows and I didn't have this automatic calculation, and it kind of got annoying as I kept changing the assumptions. Then I had to go change the distribution amount, and that was annoying. So now it automatically distributes on exit anything. If you're paying dividends or things like this, you would still have to manually put in what dividends you want to pay, and that will offset against the project's cash flow. And again, row 297 would be your cash reserve that you have in the business. So I really like how that function works. These are just calculations down here for debt service coverage, call out, the ongoing CAPEX reserve, the KPIs, also discounted cash flow analysis using the monthly cash flows. You can plug in a discount rate and get a net present value for the project itself. The annual detail does all the same things as monthly, just on an annual view. You see all that here. If we go to the executive summary, it's a high-level look at the project, EBITDA, debt service coverage, other cash flow items, final cash flow, some charts, our internal rate of return, again used in monthly convention here. Now, in investor summary, so here it's going to look at the total project cash flows in row 3, and then it's going to look at the total equity in and out here, and then the makeup of that equity between rounds 1 through 3. And these are all the same since I did it pari passu, so they'll all just be exactly the same numbers for each one. But if they were, let's say, investor round 1 put in 10% of the money, but they're going to get 50% of the profits, then their IRR is going to be higher relative to the other ones. So it depends on how you set up your percentages on the monthly detail, and that will automatically adjust these figures. This checks to make sure the project cash flow and total equity cash flow match, which they always should, and that's kind of what that last filler distribution does. So that should be 0. And then I did this kind of cash flow analysis on an annual basis for the project. And this is just the project's annual cash flows. And then I also did the equities cash flows, which is the equities just a sum of rounds 1 through 3 again. And you could plug in different discount rates and see a net present value for that. What else do we have here? Monthly annual visuals. So we're only going up to 10 years. I did do the nice data labels here with the numbers in millions. So gross revenue, gross profit, cash flow, EBITDA, gross profit percentage, EBITDA percentage, average revenue per member per month, average revenue by type. There's just 2 types, memberships and other revenues. Total studios, we just have 1. Average monthly revenue, direct costs, and gross profit per studio. So here, top one's revenue. This is, I believe, our direct cost, and then the gross profit is higher. So the difference of these two is just this amount. Total active members is just going to follow our percentage. Now, as you add more studios, these get a little bit more complex, but it all works fine. Studios open per month, average members per studio, monthly cumulative cash flow, total assets versus liabilities, monthly bank balance. This is that reserve amount that you're trying to make sure it stays above 0. So after all cash flows of the project and equity input and distribution. So if you start paying dividends, this would go down. Let's say you wanted to keep it at 500,000 in the bank, you would just pay dividends of anything above that, and then this would stay around 500,000. Assets versus liabilities annual view. And then we've got average annual revenue, direct cost, and gross profit per studio. So we only have one studio. We're saying on average it does a 1.5 million in revenue at the end exit, zero point 0.4 in direct costs, 1.1 million in gross profit per year on average. Now, if we add a bunch more studios to this, let's say we added here, and we're going to continue to use the same debt structure. Now we go over to the executive summary. You see we're up to 18 million, exit of 32 million, 18 million in revenue, 10.9 in EBITDA. And let's say we go for the full 15 years, big, bigger project. Now you can see the visuals go all the way out here. The average revenue and all these numbers stay pretty similar as the first one, as they should, because it's the same type of studio just being scaled out over time. Now you do have new studios being added that are at a lower point. So now for this, our last studio was added in month 60, but we're going to month 180 for the exit. So they're all completely stabilized at that point. So these should be about the same as what the other numbers were. What's interesting now, average members per studio, total active members, average revenue, direct cost, gross profit per studio. But now you can see how much the revenue grows and the EBITDA as you're scaling up here. I love this model. I think it's great. Any franchise business, any startup fitness studio is what it's designed for. But you could use this like on the revenue tab. This number doesn't have to be members. This could be customers that are monthly customers. And you could just say, okay, I think on average, my franchise will have a maximum of 1,000 customers a month. And then you could just use the percentages to define how long it takes you to get to that amount of customers per month. You could define you can just use one type or all three and say, okay, on average, customer type 1, 2, and 3 spends this amount of money per month. And you can even go to the OPEX if it's fixed items and say, okay, and whatever they spend, on average, it's costing you a certain amount every month as well to hit the right margins. And that could work for a franchise that's not based on member pricing, but on fixed price or selling things. And you still have the ancillary revenue here that just takes the total members times this price, applies a margin. So it's super dynamic. Then you get all this other nice complex capital structuring, leverage, scaling. I think this is just awesome. So I will leave the base version. I'll leave it as just a single studio starting up front. And I'll keep the numbers in here just so you can see. Now this is just for the financial statements here. To make the income statement and balance sheet match, you need to say how much of the reserves are sold off at the end for some amount of money. You just put like 50% here. And all that means is at exit, you're going to sell some of your CAPEX reserves or get some money for them. Now here, we are saying 50%. So we sold, the value would be 36,000 in total that we paid, and that would be this total here. If we sum it up, you see 37,033, and we're getting that much back from it. We take a loss of that, and that'll just go through to the financial statements. Now the income statement, balance sheet, cash flow all match. You can see these, our checks are to here. It took me so long to make sure that these always balance, no matter what you put in for the assumptions, but they do. Income statements just got your revenues, contra revenue, direct costs, OPEX, EBITDA, depreciation. It's easier to see if I minimize that. Net income. Annual shows you the same thing, but on an annual basis. Balance sheet, we have cash items, non-current assets here, all our different CAPEX, 3 different types of CAPEX for 36 different tranches, I think, or 36 tranches of deployment of different studios. Total assets, debt, tracking over time, equity invested, total common stock, retained earnings, owner's equity, and obviously the accounting equation has to always be true, so assets equal liabilities plus owner's equity. All our logic lines up perfectly, and you could change the numbers to whatever you want, and they will line up. Let me re-expand these. Now, doing the 3 statement model is probably one of the more difficult things. The monthly detail is not too bad to get to based on all those assumptions. Obviously, you need to know, be a world-renowned financial modeler, I believe, to do all this dynamically. But once that's done, the next step is actually trying to put it into financial statements, like a 3 statement model. And I've done that here. Obviously, it's not easy, but we match up completely, balance to the T. Cash flow statement here kind of is your uses and sources. You can see what all is affecting your cash flow. Balance sheet, this cash item here, again, we'll see our minimum reserve, which is, what did I say it was? 249,000. That should be the minimum balance that cash ever gets to. So 249, I believe I said, and it should be, right there, 249, and then it starts going back up. So there you go. It's probably taken me 10 years to get to the point where I can build something like this and feels confident that it doesn't have any errors and it works extremely well in many use cases. The value of this, if somebody's actually using it, the value of this is extreme, but not everyone's going to use it to actually scale it. They might use it for educational purposes or just to test something or whatever. So if you want to download this template, links in the description box below. It's at smarthelping.com. I think I'm going to charge. I'm going to put the price at $45 for a while, and I'm going to see how it does. I think that's super cheap, but I want to get more volume of people just into the Smart Helping ecosystem and using my model. So I'm going to price this at way lower than I think. It probably should be at 99 or 125, but I'm going to put it at $45. Put the link below if you want to purchase it. You could check out smarthelping.com. I will put it in the general industry bundle, so it'll be included in the retail trade section here. I've done a couple other franchise scaling models before, but nothing to this degree of what you saw that I just went over today. So this is super advanced. I'll put it in this bundle. Let me see if it fits in any other bundles. Capacity assumptions bundle, I'll put it into that. And obviously it's in the super smart bundle, which is all the templates on the whole site for $4.99. Let me see if it fits in anything else. SaaS and recurring revenue. Yeah, I'm going to put it in here. It fits because I did put a gym membership model in here already. Yeah, fitness center. Now, fitness center studios like having a bunch of gyms modeled over time up to hundreds or even thousands. Or the more common use is smaller studios is what that was built for. Our gym studio, fitness studio franchises. But it has recurring revenue. It has a lot of logic that I have in a lot of these other recurring revenue models, so it does fit into this category. So we're going to do it. SaaS category, industry specific category, general industries, and then what was the other one? The retail. Alrighty, that's all I got for you. You can hire me for work at $275 an hour. Pay as you go. I'm pretty responsive. Usually turnaround time between 1 and 2 days, and just email me what you want to build, and we'll get started. Usually I work in 2 to 3 hour tranches. You can see that my average hours spent per year per client, average amount paid, all the different stats about my billables, just to get a sense of how much it might cost you for an average project. But that's all I got for you. This is a really, I'm super pumped about this model. It's one of the top ones I've ever built. I can't wait to keep building more. Like and subscribe, and I'll see you on the next one.